Good morning, everyone. Welcome to our Lunch and Learn. This topic is on employee retention credit. So learn how your business can qualify for the ERC in 2020 and 2021. And we're also going to be talking about potential tax reform. So our two speakers today, Aaron is a partner in Aronson LLC Tax Services Group. Aaron is a proactive advocate for his clients, which include restaurants, hotel food distributors, retail businesses, breweries, real estate owners, professional service providers, startup business owners, and high net worth individuals. Stephen Suissa is founder and president of SHS Services. He offers over 20 years business experience in accounting, planning, and management services. And I am going to turn it right over to Aaron to get into our program. And I'll just manage the chat. And this is being recorded so people can always watch it afterwards. Thank you.
Great. No, thank you, Margie. Thank you for the great introduction. Good morning, everybody. Thank you for having me back. It's great to be back here with Steve in particular. So really looking forward to covering these two topics. And, I'm going to be covering the tax reform piece. We're going to, flip the order of it. And Steve is going to primarily cover the employee retention credit. And I cannot emphasize how important both these topics are. The employee retention credit, with me on the tax side and Steve and his team on the accounting and the payroll side, these things are massive. They are huge. And then tax reform, I'm all about planning ahead. So it's important that we think about tax reform. So we kind of want to plant the seeds for what potentially could be coming at the end of the year. And so with that, we're going to jump right into the tax reform piece. Before I get into the tax reform piece, I will caveat that it's all perspective. It's all rumors. It's all things that President Biden has proposed. It's stuff that the Senate and Congress are thinking about. So what I might tell you might be completely different, in fourth quarter. So I'm just going to tell you what the rumors and what the rumblings are from what we're hearing early on. And the first thing that, as we've learned from the tax reform is that I'm going to just be straight up and just put it out there. The bottom line is stuff is going to be going up. The last round of tax reform we had back in 2017, for the most part, everything went down, but it's going to go the other direction. And rumors are it's going to most likely be effective January 1st, 2022. There's rumors they can make this thing retroactive to the beginning of this year, but it's highly unlikely, but you never know this day and age. So the first piece that we're hearing on tax reform potentially is that right now in present day, the highest tax bracket is about 37% for federal. And that usually kicks in if you're making about a $500,000 single, $622,000 married filing joint. And so what they're proposing is to put this back to 39.6. So that's about a 2.6% increase. It's an increase, but not earth-shattering all in all. But here's one thing that could be a game changer potentially for a lot of our clients, especially on the business side, is that, Steve and I have a lot of clients where they own partnerships, they own S-corps, and those are what are considered pass-through entities. So what happens is Aronson does the business return, we prepare K-1s, and then the owners take the K-1s and they put them on their personal return. And that's what's referred as a pass-through return. But when tax reform came out late in 2017, they added this concept of a qualified business income deduction. And what that is, I'm not going to go through all the nuts and bolts of how that works, but you are allowed effectively to take a 20% haircut on your pass-through income that came through. So what would happen is that hypothetically, let's say if you're making over $500,000 as a single taxpayer and you're paying 37%, and then you're allowed a 20% deduction on that business or K-1 income, you're paying an effective tax rate of 29.6, which ain't so bad. Well, what they're proposing potentially is they're not going to necessarily eliminate this qualified business income deduction, but one of the things, and this is going to be kind of the common theme as I go through the tax reform rumors, is that they're going to phase out this qualified business income deduction if you make over $400,000. And to be quite honest, in the part of the country where we live, $400,000 might not be out of reach for a lot of people. So what could happen is that business owner previously may have been paying 29.6 on that business income, but now we fast forward to 22 potentially, and they're in the highest tax bracket of 39.6. The 20% haircut is gone. So you go from paying an effective tax rate of 29.6 to 39.6. And that's a 10% increase And I could tell you that could be astronomical for a lot of our clients at Aronson. So I don't know if that's going to pass, but that's a rumor that's on the table. Another big tax increase, and this is another one that I've not honestly never seen in my lifetime, is this increase that they're proposing to the Social Security tax. So the way that the Social Security tax works right now is whether you get W-2 wages or you're self-employed, you pay in Social Security on the first $142,000 or so of earnings, and that typically gets indexed every year for inflation by a couple grand or so. And then you're done. So if you make $1 million, for instance, of earned income, you only pay Social Security on the first 142K. Well, this is what they're proposing now. They're proposing what I would call like a donut tax, where effectively you pay Social Security on the first 142K in change. They freeze the Social Security tax, and then once you have $400,000 of earnings, it picks back up again. So it starts, it stops, and then it continues. So you kind of see where the hole is between 142 and $400,000. And that could be a big piece, I feel. And to be honest, this is the first time I've seen anything like this where there's a major proposal to really enhance and beef up Social Security, because for many years there's been rumblings, there's been concerns that Social Security is going to run out, especially for my millennial generation. So, we'll see what comes of this. But again, another one, I don't know what's going to happen with this, but that's something that's on the table. Another big one that really concerns us if this goes through is the capital gains rates tax. And the way capital gains rates tax work is if you sell an asset, whether it's business that you own or like Apple stock or something like that, generally speaking, as long as you hold the asset for at least a year and a day, you get capital gains rates, which could be 15, 20%, which is a lot more ideal than paying maybe 37, 39%. Well, what President Biden is proposing potentially is capital gains rates effectively go away if you're a millionaire. So if you make $1 million of taxable income starting in 22, instead of paying 15, 20% on that capital gain that you incurred, you're going to pay ordinary income rates, which is going to be 39.6 if this holds up. So that could be really huge for our clients that make seven figures, where you go from paying 15, 20% to 39.6. So it's almost a little more than double if you think about it to some degree. So we'll have to see what happens with that, but that's another one that's a concern. Now, I am going to give you something positive. Everything I've said, kind of sounds, oh, everything's going up and up, but there's a rumor, a very soft rumor, that there's something that might get reinstated that could be very advantageous for, our Maryland clients, our DC clients, is that back in the end of 2017, one of the things they did away with was the ability to deduct unlimited amount of state and local taxes. And that's big in Maryland, DC, where the income rates are very high in our part of the country. So, what they did was that starting in 18, you were only allowed to deduct the first $10,000 of state and local taxes, which in all honesty is almost an insult in this part of the country. So now what they're going to potentially do is they're going to reinstate that back. And I think that's going to be a bargaining chip with this tax bill potentially that's going to come through. So we'll wait and see on that. So everything I've said is really on the personal side thus far. So I'm going to switch gears a little bit briefly to C corporations. And C corporations, the way that things work right now is that if you are a C corporation as opposed to an S corp or a partnership where it's considered pass through, right now in present day, C corps pay a tax rate of 21%. And I've had this pushback from a lot of clients, thinking, well, C corp, should I convert my S corp or an LLC to a C corp? And typically we've pushed back a lot of times on that. I mean, granted, it's not a one size fit all, because in a C corp, if you pay 21% tax and you accumulate these earnings and profits, some point those earnings have to come out and you get dinged a second time as a dividend tax. Well, that sounds great, but one of the things they're proposing now is they're going to bump up that C corp rate from 21% to 28%. So that's a 7% increase. So again, while we were kind of telling people to stand pat with those S corps or LLCs, but there are a lot of people out there that have C corps. They might have switched it because of the 21% rate, or there's other reasons that you're a C corp. Again, not to badmouth C corps. Sometimes it makes sense for certain people, but this 7% increase that's being tossed around out there also could be a game changer in the C corp world. So that's really I would say, present day stuff. We've talked really about income tax, but A big tax that really scares us that could really be changing with this, and this is really more long-term, is the estate, gift, and inheritance tax. And so let me walk you through how it works in present day and what is being tossed around on the table right now. The way that estate and gift tax works in present day right now is that if you pass away tomorrow, what happens is you take your wealth, and what the IRS says is the first $11.7 million of wealth, we're not going to basically assess an asset tax or an estate tax effectively. So that gives people plenty of cushion, with $11.7 million. The other thing that's a law right now, in addition to the $11.7 million estate tax exemption, is there's what's known as gift tax. And the way that gift tax works is that everybody right now is allowed a lifetime exemption of $11.7 million for gifts. So what happens is I'm allowed to gift each individual person $15,000 per year. So I can give Steve $15,000 a year if I'm feeling generous. I can give Margie $15,000 a year, so point, no questions asked. But if I'm feeling even more generous and I say, Steve, I'm going to give you $25,000, 25 minus 15 is $10,000. So then what I do is I have to file a gift tax return and say, hey, IRS, I gave Steve $10,000 over and above the annual exclusion that I'm allowed to. And then that $10,000 gets deducted from my $11.7 million lifetime exclusion, which is not a big deal. That's fine. But here's what we're learning, what could be coming down the pipeline. First off, on the gift tax side, that $11.7 million lifetime exemption could be dropping off. And again, I've heard a lot of other professionals tell me it's probably never going to be $11.7 million ever again. It's probably going to go down to maybe 3.5 or $5 million, something like that, something a little bit more, reasonable, I would say. And the same thing goes for the estate tax. And there's two things that I've heard on the estate tax. And again, this is all in flux right now. That $11.7 million, the first thing I heard, that's going to get knocked down to $3.5 million per person. And while $3.5 million gives you a lot of cushion, a lot of wiggle room, but you think about it, where we live in the DC area, if you take your house, you take your retirement account, maybe if you have a business and maybe some other personal assets, you might burn through $3.5 million pretty easily. So, and that's where the estate tax could come into play potentially. But here's the second thing that I heard, and this was in Biden's address, back in late May to Congress, and this is something that in the estate, gift, and tax world I've never heard of, and the other state attorneys, that I've talked to have said the same thing. Biden is proposing what's considered an inheritance tax. And let me tell you what that's going to mean potentially. When you pass away and assets go to your beneficiaries, whether it's a spouse, children, grandchildren, other family members, and so forth, there's this concept of tax-free step-up in basis. And what that means in plain English is that if I have Apple stock that I paid $100 for, and if I pass away and it's worth $100,000, my kids, my beneficiaries, they get that Apple stock and their basis is $100,000. So basically, whatever the value was when I died, they get that value locked in, and there's no taxes. So, which is actually great. That's one of the nice things that's been in play with these inheritances over the years. Well, what President Biden is proposing potentially is that he wants to do away effectively with that tax-free step up. So what he is saying is that, all right, first $1 million of assets, free step up, no problem. But when you start getting into multi-million dollars, we're going to pay an inheritance tax. So to my example, let's say I'm over the $1 million threshold. If I bought Apple stock for $100 and it's now worth $100,000 when I die, President Biden is potentially proposing, all right, estate of Aaron Boker, you're going to pay a tax on $100,000 minus the $100 that Aaron Boker paid for. So it's like basically they're making us pay the inheritance or the built-in gains tax as we go, as opposed to getting the tax-free step up and then letting the beneficiaries do what they choose with. And I can tell you that is going to be a complete game changer. And then on top of that, you still have the estate tax that's thrown in there. So even when that's all said and done, if there's still wealth that's left over after the the built-in gains tax that's charged, then you have estate tax on anything over and above $11.7 million potentially. I'll be frank with you, I have no idea if this is going to go through. It's very controversial. It's, especially, in our day and age where we have a Senate where it's 50% left, 50% right. You just need one lefty to say no, and this thing is squashed. And I know Manchin from West Virginia has already said he is not in support of this. So, in all honesty, I wouldn't be surprised if there's compromises that have to be made or things in this proposal that has to be scrapped. So, to put it out there, a lot of the stuff that I threw out there, as I said at the very beginning, it's really targeted more towards the high income earners, the high net worth individuals that, as Steve and I have bantered offline about, and Steve said this very well, and I'm going to give him credit for this. When I say compromises, they may have to say, okay, government, we need to get some revenue in, but we may need to go after the folks that make maybe six figures or make a little bit less income, or maybe have a lower net worth to kind of make up the difference on some of this stuff. So while in present day, from what I'm reading, I don't see the people that are making 400 and under or have small states being impacted by it, but you never know. So then with all that said, so then the question is, okay, what do we do now? What does this mean for me? What does this mean for my business in present day between now and the end of the year? And I would say a couple things. One is pay attention. Just keep your eyes and ears peeled, and be ready to move when stuff happens. The second thing is that, as the big takeaway, is that income is only going to go up, tax rates rather. So maybe if you're able to, maybe considering accelerating income in 21. As a tax professional, one of our tax planning strategies is to defer income a year, but we might be doing it in reverse this year, where we're going to tell people pick up the income in present year when the rates might be lower potentially, because it's all about playing the tax rate games with all this. And then if on the estate in the gift front, this is really more targeted towards the high net worth individuals. We may never see an $11.7 million gift exemption. So if it makes sense, consider gift and assets, but that's a very difficult and a very, high level conversation needs to be had. And I can tell you from the handful of clients I've had those discussions with, it may sound great on paper, but it's very hard to part with the assets. It's very hard to part with the income that it produces. But again, there's a lot of pieces and discussions that go into it. So again, big takeaway, be prepared to move, consider accelerating income if you can, but it's going to be very important to really talk with an accountant or a tax professional or even an attorney to some degree, as these things transpire. And it could be last minute. This stuff could go down November, December, may not be a lot of time to act. And there's a chance something may not come through. We just don't know. So to be continued with that. So Steve, anything to add on that?
Yep,
on that front?
Couple questions for you, obviously. So, mentioning the estate tax, sounds like at the end of the day, if some of this passes, even folks that get an inheritance are going to have to find a way, if they're not cash rich, to pay for some of the taxes on the inheritance, whether it's a home. I mean, if you inherit a home that's worth $1 million or $2 million, and you have an IRA that's passed down, you may need to come up with cash to pay for some of this stuff, right?
I agree. So, and that's one thing from a practicality standpoint. I'm all about being practical. That really bothers me about this. And I know I'm supposed to have an objective mind of view, but if you're inheriting a house from mom or dad or in a retirement account, and these are not what I would call liquid assets, as in you can easily turn around tomorrow, but it's almost to the point where there's no cash. You have to sell the assets to pay the inheritance tax. And that's just not, I don't think that's really what this was intended for, in all honesty.
Do you feel, just to jump on the tax bandwagon here, you think, or do you think that state taxes will go up as well?
State taxes? That's hard to say, with the state taxes. And I think that's all, it's on a state by state basis. I'll tell you, in recent years, a lot of these state governments, the Marylands, the DCs, and I'll go outside the area, the Californias, the New York, they're bottom line, they're all hurting for money. And especially with the pandemic, a lot of these states lost a lot of money in the last year or so. So, and I think it's going to be on a case by case basis, but I would not be surprised if some of these states come out there and say, all right, we're going to do our own thing. We're going to have our own separate increases. Some states might be a little more generous and say, we're going to match federal. We're not going to match, federal per se. It just depends. So it's hard to say, but I wouldn't be surprised if you see some changes on some of these states potentially.
So I can tell you from a payroll perspective, right? We've seen, at least for Maryland, we've pretty much seen every single company unemployment rate go up. And
Yep.
Unfortunately, it wasn't really announced. Very few clients that we know of got notices that mentioned that there was an increase. So there was this huge catch up for Q1 when people started realizing in April and May that their rate was last year's rate and that Maryland increased the unemployment rate. It was incredible.
Yeah,
But
it doesn't surprise me too, especially all the clients we dealt with on the business side. They had to terminate their employees in last March or April because they just couldn't keep these people. And a lot of these folks stayed on unemployment given the state of the market and given, I hate to say it, some of the benefits that were offered with some of the unemployment side. So you're right, there's a huge shortfall on the state level. So I'm not surprised by that. And it might take a few years for these states to get caught up.
so if you think about it, really forgetting income level for a second, having a potential tax rate of almost 40% on federal, and then adding the state to that. I mean, you could see anything from 50 to 60% of your money going to taxes. I mean, if you add sales tax on top of that, and you add all this stuff you're paying, as you're living your daily life, it could be pretty significant chunk of your money that's going out.
I agree, Steve. And I think one of the big takeaways from this, and this was really the goal in the game last year, is that as business operators, you really had to change the way you did business, the way you managed your costs and all that stuff. Because with the pandemic, you weren't getting the same volume of revenue that you had, but you still had to pay your landlord, you still had to pay your employees, you still had to pay your admin costs. So you really forced you to really take a step back and rethink how you did things. And even with that said, people are still digging out from the pandemic. And then you throw in a 50, 60% blended tax rate between all the stuff that you mentioned. It's going to force you to change the way you do things.
So I think then to kind of piggyback on that, I think what's really important that you're saying is, number one is figure out how to reduce your taxable income, right, in your business. Set up 401k plans, talk to a CPA, figure out how to strategize, maybe cash balance plan, something that helps you, and your employees reduce that
Absolutely. Yeah.
income, right? And that's not advocating for a retirement plan. I'm just saying, talking to your CPA and figuring out how to reduce some of this taxable income, no matter what level you're at, is extremely important, right?
Yeah, and I don't disagree with that. That is a very good point, though. I mean, I think it's a mix of managing just from a business operation standpoint, managing your taxable income. Back to one of the comments that I made earlier, one of the year-end planning strategies we do with our what I would call our cash basis clients, where it makes sense that we do planning for is defer the income. And I would say in 21, the goal is to probably accelerate the income with stuff coming down the pipeline, presumably. And I think we're going to get an answer probably November or December, most likely. But come 2022, when all these high income rates kick in, then maybe the deferral strategy is back on the table, maybe defer collecting some of the receivables, maybe accelerate paying some of the payables. But again, that's cash that you got to pay out to make those expenses. So it's not a black and white answer. And it's a discussion you got to have with your CPA.
Well, it's why it's absolutely worth having a great CPA and having a great bookkeeper that you're able to know what your financials are on a day-to-day, week-to-week, month-to-month basis. Because
Absolutely.
we've, as business owners, you've got to stay ahead of the curve on this.
Absolutely. That's right. I agree.
And
Oh,
not to dovetail into the other piece of this, but we've had, as business owners, right? If you qualify, you've had so many opportunities to try to help your business between grants and PPP and EIDL loans and ERC. All of this stuff has just been available. It doesn't mean that everybody's qualified. It doesn't mean that you just because you qualified for PPP 1.0 doesn't mean you qualified for 2.0, right? And small businesses and mid-size are probably also hurting, continuing to hurt.
yeah, and I agree with that. And I think that's a great segue to the next topic is that really one of the goals and objectives with all these programs they've released in the last year or so, and some of them are still out there, as we're going to talk about one of them, is make sure you're taking advantage of everything that's out there because the goal is to manage your expenses and get as much cash flow as you can into your business. And what Steve is going to cover next, I cannot emphasize, is a astronomical cash flow tool that's out there that really should not be ignored. And we've done previous discussions on it, and I think we're going to revisit it right now.
Yeah, well, the second part of this topic is the Employee Retention Tax Credit, also known as ERC or ERTC. One thing right off the bat to understand is that any credit you get back, any money that you get back, Aaron will tell you, it is taxable. So this is not PPP free money. This money that you do get back under ERC becomes taxable. And
Right.
so it's important to know that. And, we always say that, right? Taxable income is better than no income. But that also is going to mean what does that do to your top line, bottom line, and effective taxable rate as well.
Mhm.
So there are some business owners that are going to jump up in tax brackets as a result of this, and it's important to understand that. So,
And just to be clear, I don't mean to jump ahead, but I want to say this is a tax professional. And everybody, please listen very carefully on this. As Steve says, this program that he's about to introduce, it is a taxable event. You take the cash flow any day over the tax deductions. You take the cash over the taxable income any day, because the cash is worth more than any tax rates, any tax deductions. You're still going to come out ahead any day, even if you're paying a little bit more in taxes.
and it's really important to emphasize and to understand that the ERC calculation is not an easy calculation.
Mm-hmm.
I mean, it is very, very cumbersome, and it's very complicated. And it may seem simple in the way that Aaron and I are going to explain it now, but understanding, right, when you can use it, how you can use it, what period is affected by it, what other programs are involved in it is what we're going to be talking about at a high level today. So essentially, there are what I call two components to ERC, right? There's the 2020 component and there's the 2021 component. And so, the employee retention tax credit is basically a refundable tax credit against certain employment taxes paid and certain gross wages paid in 2020 and 2021. So if we can choose, we can talk about these 2 years in different ways. If we look at 2020, what ERC is allowing you to do is to look at quarter by quarter your 2020 compared to the same quarter in 2019 and determine if you have had a 50% or greater loss in income. That allows you to basically calculate a refund to you of gross wages and some healthcare costs up to 50% refund with a cap of $5,000 for the year. It's important to understand what that means, right? So let's say that you qualified, right, for that 50% loss in income, and you have 10 employees. That's a cap of $5,000 per employee for the entire year. So, you would get a refund of $50,000. And that is actually an amendment to the 941 federal tax return. There are calculations that have to happen on the back end, right, in order for that to happen. Let's talk about 2021, which is interesting because 2021 was actually extended in December. So now 2021, you can actually qualify for Q1, 2, 3, and 4 of 2021. The caveat or the change for 2021 is that it is a 20% decline in your revenue of 2021 compared to 2019. So having your books in order, whether you're cash basis or accrual basis, right, is extremely important to understand so you can analyze that and understand which quarter you qualify for. So one of the, and again, just going from notes here, because there is a lot of information and there are a lot of changes to this program as well. And we're not sure what additional changes are going to occur. So it is a good idea to get moving now, get it filed, get it amended, right? Because you don't know what's going to happen in 3 months from now, 2 months from now, 6 months from now for any changes. They may come in and they may reduce this benefit based on the amount of money that is going out. A lot of businesses are qualifying that we have seen that we are amending and filing for. We're doing the calculations and amending, and we're seeing a lot of businesses qualify for 2021 especially, because a 20% decline is not that hard to have in this type of an environment. So where the requirements are is that for 2020, employers, including tax-exempt organizations, are eligible for the credit if they operate a trade or business during the calendar year of 2020 that experienced either a full or partial suspension of operations of their trade in a calendar quarter because of governmental orders, right? Or a significant decline in gross receipts. It's easier to meet the gross receipts test, right, than the government shutdown, because the government shutdown was pretty much partial for most of these entities, right? Other than Aaron, right, the hotel and restaurant business that got really slammed by this.
Yep, that's correct.
The decline in gross receipts begins on the first day of the calendar quarter, and it ends on the first day of the next quarter. That's the way that it's calculated. So it's important to understand what that means and compare your quarter to quarter. That means essentially that you could get a 50% refund of your gross wages up to the 5,000 cap per employee for 2020. For 2021, what was really interesting was that they actually increased that cap to $7,000 a quarter. That is 70%, right, of the $10,000. So $7,000 per quarter means a $28,000 potential refund for 2021. Now, obviously, we're only through quarter one, right? We haven't completed quarter two. We can't file quarter two, right? Because we're not done yet. But if you see that you're trending in this direction, you could potentially file quarter one on July 1st, file for quarter two, your amended return, and you could be literally getting $14,000 per employee refund. So it's pretty amazing and pretty significant. I won't get into obviously the politics of this and dealing with the tax piece of this, other than saying that all of these credits have been amazing. We're going to pay for it in the end, somehow, some way. But that being said, if we're all going to pay for it in some way, shape, or form, you might as well file, get the money, get the refund, put it in the bank, and then be able to just pay the taxes on it, but help your business survive and make it through the next period. We don't know what's coming from that. Now, there are some exceptions to this. This is not just a decline and you can file and it's a freebie. There are some exceptions. If you received a PPP 1.0 or PPP 2.0, as I'm calling it, you cannot submit an amendment for the period. You cannot use those wages paid out with the PPP funds and apply for that credit. So if in Q1, let's say in Q1 of, let's say Q2, just to use an example, in Q2 of 2020, if you had a 50% decline in revenue as compared to Q2 of 2019, but you ended up getting PPP funds and used PPP funds for the entire quarter, right? You are not eligible for ERC. Those dollars, right? Your payroll was funded by PPP. Government is not allowing you to double dip. Now, the caveat to that, right? If you've got a really good bookkeeper, accountant, right, payroll company, they're going to come back and tell you the PPP rule says that you need to use 60% of PPP for payroll, the gross wages. If you're able to calculate your PPP based on that 60%, the other 40% is actually eligible. You can actually use the 40% as part of ERC. That may allow you to qualify for Q2 and actually get a refund, right? At least partial for that difference. So that's where we're saying that it's not just a simple, yes, we qualify, no, we don't. There's calculations that have to occur in order for this to happen. So the second part of this is if you have used the FFCRA pay codes during any of this period as well, those wages in which you got the tax benefits for FFCRA disqualify you for applying for ERC and the tax credits. And that's important to understand because PPP, FFCRA, and there are some businesses that qualified under section 445S, right, that will not allow you to also claim ERC. There's companies that file tax credits under the Work Opportunity Tax Credit, right under Section 51 of the IRS code. That disqualifies you from using ERC during that time period. So it's important for you to have all of these calculations and understand how it's impacting your business, because the consensus on this, and Aaron can agree or disagree with me on this, is that there are a lot of companies applying for ERC. This will be audited at some point, whether it's a box audit or an in-person audit. The IRS is going to ask for substantial proof. They're giving this out now. They're taking your word on the amendment, right? But there is going to be a review, right? And an understanding of how this amount was calculated and gotten to. Claiming the credit, as I said, is a matter of contacting the payroll company or contacting your accountant. Most accountants we know have been willing to do some of the calculation on the back end, but not necessarily amend the 941. They've deferred that to the payroll company because we've got all the wages that are built into our system, and we've programmed all of this to be able to spit out the amended 941 with a lot of obvious calculations that need to occur. The American Rescue Plan Act, as I mentioned, at the end of 2020, changed and extended the ERC really to the end of 2021. So it's important for you to work with your accountant, your CPA, and your payroll company to make sure that when you do qualify, that you are getting this. And what is interesting is that we have found that there are some clients who did not qualify for PPP 2.0, but were able to qualify for ERC. And so it's important to understand this and how this is affecting you. So just to kind of recap this, right? For 2020, eligible employers must have between 1 and 100 W-2s. Their eligible business must have been in business in operation before February 16th of 2020. The maximum credit amount is $5,000 per employee for 2020. And the credit calculation is 50% of the qualified wages. In order to qualify, you must see a decline of 50% in gross receipts when compared to the corresponding quarters in 2020 versus 2019. This also means that if you qualified for Q2 of 2020, you also automatically qualify for Q3. So there are a lot of folks out there that don't understand that, and a lot of payroll companies that don't understand that. So there's some companies that have filed the amendment for Q2 for clients, but didn't do Q3 because they don't understand how it applies. They're just listening to what the client is saying and not providing the advice. So that's important to understand. For 2021, January through December 2021, same thing applies. You must have been in operation before February 16, 2020. The maximum amount of credit is $7,000 per employee per quarter for a potential of $28,000 for the year. The credit is 70% of the qualified wages. In order to qualify, you need to see a decline of 20% of gross receipts from 2021 to 2019. What's important to understand there is that, and what I've mentioned a few times, is that one of the guidelines is saying that you need to be in business before February 16th, 2020. There is a caveat in that says if you opened your business in 2020, you actually may have the ability to qualify for ERC. And Aaron, I may ask you to step in. There's a certain term for it. I'm trying to remember the term. I'm drawing a blank. It's the new business tax credit.
Yeah, I forget the word offhand, but I know what you're talking about. There are some avenues where if you didn't get your business in before 19, you open it after the fact. There are some methodologies, and I don't know if it's worth going into the details, but it doesn't mean you're out of luck on this thing. There's
Yep.
alternatives towards getting this credit.
It's called Recovery Startup Business. If you want to search ERC and Recovery Startup Business, that actually allows you potentially, if you began operating after February 15th, 2020, to potentially get a deduction. It's capped at $50,000, but there is an ability to qualify. So you need to understand the law and need to review this. So there is potential, and there's a lot of potential out there. So I'll leave you with that information. Again, just to remind you, any of these tax refunds through the amendments of your 941 are taxable. They're recorded as income, but as Aaron said, income that's taxed is better than no income at all.
Agree. Steve, that was a lot of great information that you gave. And I can tell you, this has been my life for the last year or so dealing with this credit, and it is complicated. And Steve's been in the weeds with it just like I have as well. But it is, I'll try and say this objectively, it's a generous credit that they're offering. I mean, the fact what Steve illustrated, especially with the 21 credit, you can get a $7,000 credit potentially for each employee in each quarter. And I'll tell you at Aronson, we deal with clients of all shapes and sizes. This is benefiting everybody, the small guys, the mid-size, even these large, GovCon clients that we work on where there's over 100 employees. I've seen these credits go anywhere from, $50,000 to $100,000 for the little guys, several, $100,000 for the middle guys. And these GovCon clients, they start pushing seven figures potentially per quarter. And we got a lot of clients that are going to qualify for multiple quarters. And this thing is good through the end of the year if you play your cards right. So there is a lot of money at stake. This is not something that should be blown off or ignored. But Steve brought up a very good point, and I agree with him. At some point, something's going to have to give. I think the light bulb's going to go off at some point with Congress thinking, we made this thing too good. How are we going to pay for all this? So I would not be surprised if they lower the ceilings and the limits on this thing at some point. But in the meantime, if you're eligible for it, go for it. 20% is not, it's not out of the question compared to the 20 version where it's 50%. And the one thing that I found that was really interesting about this is a COVID-19 pandemic program. I have not seen anything in the IRS guidance or the code with this that says the 20% dip has to be tied to COVID-19. I mean, I keep referring back to GovCon. GovCon, you could lose one contract unrelated to the pandemic. You're good. You qualify. Period. End of story. It's all about the revenue. And to Steve's point, it's really important that you have a good set of books for that too. So definitely we just cannot emphasize how important this credit is. Steve, go ahead, Steve.
Aaron, I mean, we have done, unbelievable amount of amendments, really over the last year. And what we have seen is, our smallest amendment that we have seen was a $10,000 refund. The largest amendment that we've done has returned to the client in cash over $1 million. It's been an unbelievable lifeline. I mean, and as you said, 100%, it's not COVID necessarily related. Any business that has experienced any revenue decline, right, qualifies for this. And it's about understanding how to calculate the numbers, how to take advantage to the maximum possible of how you qualify, understanding if you qualify for one quarter, how that carries over to another quarter. There's a lot of people out there that are claiming to be able to do the ERC, and some of the larger companies as well, larger payroll companies that are not filing this correctly. And they're not giving the advice. They're taking exactly what the owner is saying to them, not asking the right questions, and then therefore not maximizing the return and the benefit.
Right. And just to be clear, with all this, and I've told my teammates at Aronson about this, you need to have a phone conversation with your CPA. Don't do this over email. You need to talk it through. These are not black and white cases. Same thing with PPP, which I'm going to get to, next, but you need to have a conversation with the accountant, talk it through. Every circumstance I've found with this credit is different. And so you want to make sure that you do this right. And I think there's a chance these things are going to get audited given the size that these credits are coming out to. Steve, you touched upon PPP and the interplay with ERC, which I think is very important. And to be honest, in my professional opinion, that's the biggest headache that I have with this program is that you got to interplay it very well. And be honest, if it's between the two, I'd rather have the PPP forgiveness because that's 100% free money, non-taxable, versus the ERTC. It's 70% on the first 10K of wages per quarter, at least for 21. But our goal and objective as professionals is we want to make sure that we're helping our clients maximize as much as they can out of both programs. So there's a little bit of strategic plan that goes into the interplay with PPP and ERC. A couple examples Steve mentioned. With the PPP, you have to spend at least 60 on payroll, and you can go as high as 40% of the loan on non-payroll. So one of the the games that we're doing with clients is let's max out the non-payroll bucket as much as possible. I mean, I know it's very easy just to cut to the chase and just dump it on payroll, but that could be some big credits you could be leaving off the table. Another thing that I've helped out with clients is, just because you get your PPP loan on February 1st does not necessarily mean you have to turn around on February 2nd and start spending on payroll. You could defer spending that PPP money in March, April. You have 24 weeks to spend this thing. So what we've told some clients where it makes sense as an objective to try and max out these credits is, all right, let's defer PPP another month. Let's max out these ERC credits or tap out what we can. And then let's turn on PPP and then turn ERC back on once PPP is done. So it's like a dance a little bit. You got to really look at the numbers a little bit. And a big thing that comes into play is what quarters do you qualify? What quarters do you not qualify? And some of these answers we may not have until Q2 is done, in all honesty. So it's tricky, though. You really got to strategize and talk this thing through with a CPA.
And you also got to be really careful about if you have already filed for PPP forgiveness and you have used one method, do not try under ERC to change what you filed or the way that you filed. If you used 100% of it for payroll, and that's the way that you filed for PPP forgiveness, do not try with ERC to claim 60% and use the other 40% for ERC. It will bite you in the end.
Right, and they've had guidance from the IRS that says if you already filed PPP1 forgiveness and you put 100% in payroll, tough, unfortunately.
Yep.
So the play is if you haven't gone for PPP1 forgiveness yet, although professionally speaking, you should, because you got 10 months from the end of the covered period. That's going to expire very soon. This is a very important part. Consider, maxing out the non-payroll piece and think about the ERC piece. So again, this complicates the PPP forgiveness now. So, but it's something that should not be discounted.
Absolutely. And so I think that, we're already at 12:15. Should we open it up for any questions that anybody has?
Yes, thank you both so much. There aren't any questions in the chat right now. If anyone wants to unmute and come on video, feel free to. This is your chance to get your questions answered by the experts we have here. And I appreciate both Aaron and Steve for, being such a great resource from the beginning of the pandemic. We've been doing this all throughout the whole pandemic, and you guys have been wonderful.
Thank you.
Archie, thank you for putting this on and allowing Aaron and I to jump on. I know that Aaron and I, we can speak for each other that we are huge supporters of the Rockville Chamber and of local business. Local business is really what makes the world go round. It's like 98% of businesses are local businesses. And that's really what we aim to support, make sure that we all get through this and succeed.
Yeah, and I echo a lot of what Steve said. Thank you for having me. I keep coming back and doing these webinars. I enjoy doing them. It's great to give back to the local community to some degree, but I think there's a lot of value that these webinars bring. It's invaluable information that we've covered. We've had Rod Johnson on here many times. There's been other speakers. This is how we're getting our teammates through this pandemic, these programs.
Absolutely. Absolutely.
And hopefully, starting next month, we're going to be doing these programs in person, and our lunch and learns will be at a restaurant. So we're lining all that up now. But I want to, since there aren't any questions in the chat, just thank you, Aaron and Stevens. So I want to talk about our next Mix and Mingle is coming up on the 17th, and that's with the women business owners, and it's going to be on Zoom. Then July 15th is our first in-person Mix and Mingle at Pinstripes. And we're also combining it with a marketing webinar We're going to be talking about creating blogs and how to do that. So we'll be outside at Pinstripes. And then we have another lunch and learn on August 6th. That's going to be with Tim Fahey about technology to enhance your business. And then we have LeaderCast. I don't know if you're familiar with LeaderCast, but it's a live simulcast. There are 12 international speakers, and the topic is shift. So how timely is that? How to shift your business to go forward. So it's live from Montgomery College all day. Early bird tickets are $99, and then it goes up to $129 after July 1st. If you can't make it to the live event, there is an opportunity to get a link to watch it afterwards. And then we're having our inaugural golf tournament on August 16th at Montgomery Country Club. It's 7:30 registration and breakfast and 9:30 shotgun. So come out and play with us. And then August 19th is our mix and mingle with the only chamber at Silo Falls. So that's the lineup through the summer. And we're going to continue to keep bringing these programs to everyone. And this recording will be sitting on our website under webinars. So thank you both very much. And we have a whole library of resources of all of our webinars to keep going back to. So again, thank you very much, and hope to see you out shortly.
Definitely. Thank you to everybody too for showing up. Really.
Thank you. Thank you as well.
Bye-bye. Have a great day. Have a great weekend. It's Friday. Bye-bye.